Ladies and gentlemen, good morning. I would like to welcome you here on the day 2 of the European Summit. The session is Investors Outlook. So I would take a few minutes for introduction of our chief guest and other panel members for this session, and then we can proceed further for the Q&A session. So the name of the session is Investors Outlook. The panelist and chief panel for the day is Jin Pascal Rollins. Hello, Jin. Thank you very much for joining us.
Hello. Thanks very much for accepting me to this summit.
Thank you very much. So, Jin, I would like to give a brief introduction about you first. Jin Pascal Rollins was born in France in late 1950s. He studied accounting and finance at ESSEC in Paris and gained the CFA designation in 1988. He has a great deal of experience in the financial sector and has been a fund manager for just over a decade. He spent 22 years at BNP Paribas with 10 years in corporate banking and 5 years each as a French equity strategist and head of Japanese equity research. In 2004, he left BNP Paribas and became the CEO and CIO of L&T Funds. He is the lead manager on the USLIS LT Funds European General Fund. Outside of fund management, Jean is a great fan of the outdoors and lists walking, gardening, and forestry among his hobbies. Jean, I would take the great opportunity to invite you for the speech and introduction. Thank you very much once again.
What I think in terms of investment outlook is that it's a very good time for equity investment, particularly in European equities. After the bounce related to the COVID-19 situation, the economy, world economy and European economy should regain its normal course. And the normal course is that in 2019, just before the COVID situation, we were at sort of a trough in terms of economic cycle. And this economic cycle is now resuming. Thanks to the normal economic cycle, but thanks to the monetary stimulation from many central banks, and also thanks to the natural growth of emerging markets. China, despite all what people say, is still growing. And there is a new perimeter of emerging markets pulling world demand in terms of basic resources, which are India, Pakistan, Bangladesh, Indonesia, Philippines, Vietnam. All these countries together are 2 billion people, and they are adding a marginal demand, which is enough to trigger a new long economic cycle. So I believe that particularly in the context of very low bond yields, equities is a very good asset class to invest in still now, despite European markets being at their 20 years high. People say, oh my God, we are at a 20-year high, but my answer is, so what? It's natural that markets reach all-time highs from time to time and regularly, because equities are the quintessentially way of participating in the...
JP, sorry to interrupt you. Can you check your camera?
Can I take my...
Yeah, can you check?
Camera, it's working now.
Yeah, but Hetal is blocking my... All right.
Yeah, now you can.
No, it's working now.
Right. So, yes, so it's the nature of equities to go from high to high as long as the world economy grows. And people must remember that this time the all-time highs were reached in in the US, thanks to a few trillion dollar stocks, and in Europe, thanks to a few sectors which valuation was pulled to unreasonable levels, such as luxury or the few tech stocks which are in Europe. If you exclude these stocks, we are far from all-time high, and we are at a very reasonable valuation. So, what are the stocks we are happy to invest in? All stocks which are growing, which are at a reasonable valuation, and also all stocks which have been COVID affected, as the COVID situation has weighted on these stocks this year still because of the H1 government shutdown. So there is a lot of catch-up potential in this category of COVID-19 affected stocks. So how do we select our stocks? I sent you a presentation, and in this presentation I show how we select stocks, especially on page 2 of the presentation, which I can share with you. So that's the presentation that I will, the slide that I would like to show. As far as we're concerned, we are pretty classic. It's very difficult to do stock picking other than with darts. So you need to have, or at least I think it's necessary to have a selective investment process. So that's how we select our stocks. So first we eliminate all stocks which are not listed on the main market, because we do our own research and we need reliable and regulated information. So no AIM in the UK, no Altonext in continental Europe, no Bern market in Switzerland, just really main market listed stocks. And then we also eliminate all stocks which do not have 100 million euro free float, because this is institutional money that we are managing. So we need a reasonable level of liquidity, and 100 million euro is a minimum. We eliminate also all stocks which have not been listed for 2 years, because we believe that the fair price of an IPO is 2 years after the IPO. Then again, we are pretty conservative or classic in our approach. So we just apply what Warren Buffett advises, i.e. to invest only in what we understand. So we are not, we have financial backgrounds, we are not engineers, and we prefer to leave tech stocks to others, simply because, for example, I barely understand how the telephone works, so don't count on me to invest in software telephone companies or else. So we don't invest in tech, we don't invest in pharma, as we are not pharmacists. And you see, initially Moderna, I thought it was not a serious company, so because I'm not a doctor. So we don't invest in mining or oil companies, because we are not mining or oil engineers either. So that leaves still plenty of classic sectors which offer plenty of finely growing companies which are still at a reasonable price. So these companies must be focused. The 21st century is a century of specialists. So the company not only must have only one activity, no conglomerates, but the company must have a competitive advantage and a measurable competitive advantage. So a measurable competitive advantage can be seen in downturns, when there is a recession or a COVID crisis. If the company gains market share, clearly it has a competitive advantage. And gaining market share in downturns for us is a very good test of competitive advantage. And then the management must be from the industry. We don't believe in consultants running an oil company or a bank. So banks must be managed by bankers, and chemical companies must be managed by chemical guys. So the management also must outperform its sector. So after 3 years, management must prove, because for the first 3 years, the management inherits from a previous situation, bad or good. But after 3 years, the management must prove that it outperforms its sector. In terms of financial analysis, we don't mind companies with debt, except that the debt must be bearable. So above 100% gearing ratio, we tend to be shy. What is very important for us is EBITDA growth. EBITDA growth over the long term, and we are long-term investors. EBITDA growth is, in the end, what drives the share price, is the growth of the cash that the company generates. And so we put a lot of emphasis on EBITDA growth. And finally, Hetal mentioned that I was for 10 years a corporate banker, so that leaves you with some background, let's say. And I look at the big risk of a company, and if a big risk is too big, or such as a super cyclical company or company depending on one client or one product, I leave it aside. And if there are a few big risks, I then adjust the position in the portfolio accordingly. So, for example, for many years we were investors in LVMH, and then we sold it for valuation reasons, as we run company portfolios on a GAAP basis, growth at a reasonable price. But in LVMH, you have two big fundamental risks. You have the CEO, Bernard Arnault, who controls everything, who decides everything, who checks everything, who builds up his empire very successfully, but is the only one builder. So is 72, and that's a significant risk. And the other big risk, fundamentally, is the Louis Vuitton brand dependency, which still, despite Bernard Arnault's efforts to diversify its dependency to Louis Vuitton, it's still 55% of the company profits. So I was an investor in LVMH, but I kept 4% of the portfolio. So we reach an investment universe, and then we, in this investment universe, we pick up stocks on the maximum 10 times CP/EBITDA basis next year, and we carry them as long as they grow at a minimum EBITDA growth rate, and we sell them when they are from 15 times the EBITDA. So that's how we do, and we do manage our portfolios and select our stocks. And again, because the outlook is exceptionally bright for equities, I have never seen a demand as strong as now for the last 40 years. The demand is much stronger than the offer overall. That is very good and favorable for equities. So we run concentrated portfolios. The modern portfolio theory says that, and proves mathematically that the optimum of a portfolio is between 12 to 15 stocks. And because of regulations, risk regulations in our funds, we need to have 22 stocks, and I normally have 25 stocks because our positions are not equally weighted. We have positions at 2%, 4%, 6%, and 8%, depending on the long-term fundamentals of the company and its valuation. So that's how we do things. Our main positions are 𝗂𝘃𝘃𝗀. 𝗂𝘃𝘃𝘃𝗀 is a world leader in industrial gases, and it's a company I've had in my portfolio for the last on a documented basis for the last 38 years, and it delivers. It has been delivering a 7% annual return for the last 38 years, and that's the idea of our portfolio. I'm not looking at getting plus 20% or plus 30%. I'm not in that business. I don't know how to do it. I just try to have over the long term a fine risk-reward basis, and over the last 22 years, I've managed to grow the portfolio at 7% per annum, which is 3% more than the MSCI Europe index. So we are now at 20 minutes of presentation, or technically 15 after the introduction. And I'm quite happy to take questions or to carry on or to describe talk about some of our stocks, or talk about our company.
Sure. Thank you, JP. It was a great presentation, and I'm sure that attendees and everybody were enjoying this, the process of how stocks are being selected and every single process. Now I would like to give introduction to our other members who are in the panel as well, and post that we will start taking the questions. One of the members is Jordi-Ferran Penina. He is investment associate at Inveready. Another is Adrián Macho, investment analyst at Inveready. Our moderator for the session is Erik Storelv. He is Chief Finance Officer at Protectoria Venture. Hello, everybody. Thank you so much for joining the session. If you could give introduction, Jordi, Adrián, and Erik.
Yeah, sure. So I'm Jordi. I work for the Venture Debt vertical in Inveready. We are a fund that has many verticals with venture capital, let's say technology intensive, biotech, convertibles, private equity, and some other things. Adrián and me in particular collaborate within the Venture Debt, which is like a product. It's a mix of debt and equity, where the company needs to amortize a loan, but we also ask for a, let's say, shares remuneration, which is less dilutive than pure equity.
Mm-hmm.
Yeah.
Yeah, and as you already mentioned, I think it's interesting to introduce a little bit more about Inveready, because we have a different point of view as someone that is investing in quote companies. Inveready is an alternative asset manager, mainly based in Spain and mainly focused in Spain. As you already said, we invest in different verticals. We are more focused on the venture debt side. And in the venture debt side, our outlook, I think, for the 2022 is pretty good, because I think startups will continue needing money. The only problem we are observing is that due to the high liquidity in the market, valuations are rising and are now being quite a little bit crazy. But that's a problem you solve with some rigorous methods of analysis and discarding some companies due only to this reason, because of the valuation, because valuation makes your returns more difficult. And I think on the private equity side, what we are also seeing is that this liquidity is leading some players to open or to launch new funds. So what we are observing is more and more competence. I think this is different from the quote side of the life. I think it's interesting.
Great. Thank you, Adrián. I would request you guys to please turn on the videos as well. Thank you. Erik, would you please introduce yourself?
Yeah, thank you. Do you see me? Is my camera working?
Yes, it is working. Thank you.
Yeah. Okay. Hello, everybody. I am a CFO in a Norwegian technology company, 𝗓𝘂𝘁𝗃𝘀𝗁, and we'll talk later, but we deliver a digital ID infrastructure in line with the European vision for digital IDs for the Europeans. We have contracts in the Philippines and hope to grow significantly. But I feel a lot in common with the other panelists here because I've been equity analyst in the leading Nordic banks, the SE Bank, the leading Norwegian broker, 𝗢𝘂𝘁𝗲𝘀. So I've been analyzing companies for 15, 20 years. And also been investor in the largest insurance company in Norway, where I run the European portfolio. And I also run a hedge fund in technology for a couple of years. So I recognize a lot of what Jean-Pascal is saying. Actually, his structure of a portfolio is almost similar to the one I had in my hedge fund. So the 246 and the growth approach, although I also invested a lot in technology. I have studied from Paris, Institut d'études politiques de Paris. I'm half French, half Norwegian, so but we can stick to English here for the panel.
Thank you, Erik. Thank you for introduction. Now you can proceed as a moderator, and I'll hand over to you. Thank you.
Yeah, thanks. What I understand is that we'd like to discuss the world economy and what it means for the investment opportunities, and each of you have a different profile. It would be interesting to touch about the general economic situation. What the main thing is now is I actually like to start with a question, which I think is the most important one for us now, is how do you see the uncertain economic development, how that will affect the availability of capital, both for equity, venture capital, and private equity? And I noticed Jean-Pascal's very positive view on the equity side, but I invite each of the panelists to discuss, do you see the very positive inflow into more risky assets to continue with this uncertain economy?
Yes, I think I can take it, and then Jordi can add whatever he thinks is interesting. But our outlook, especially for 2022, we don't know, but we expect 2022 to be the first year where it's going to be a decrease in the investment in alternative assets, but it's not going to be significant. The other day I saw a graph, and 2021 has reached all the limits since we have records of money going into alternative markets. And I think as the central banks are now discussing or thinking about changing or increasing the interest rates, this money, this inflow into alternative assets is going to decrease, but I don't think it's going to happen, or we are not going to see this in 2022, but I guess more than 2023 and onwards. But at the same time, the liquidity right now in the market is so big, and all the funds that have been fundraised will have to be invested. So I guess the opportunity for founders or for people selling their company, it's going to continue to be great, because as this liquidity is going to be so high, valuations, we expect it to continue to be high. The only problem from our side, I think, is that this liquidity, these high valuations are going to lead to worse returns of the funds. And I think in the long run, many of these funds that have been launched due to this high liquidity will have to close, because their returns are not going to be as good as expected or as promised. We are quite calm because we have a good track record. But I think this competence market is going to make us to make our work more difficult, which is also good.
Yeah. Some other opinions?
Yeah, I would like to add, I'm really in what Adrián says, but at the end, all these valuations are a matter of combination of expectations, and these expectations now are super high due to the high liquidity he's mentioning. People are not being that much rational, and I think this has been partially boosted this last year due to the pandemic as well, and that the, let's say, the lack of generalized common sense when evaluating opportunities in the venture capital area, which is where I mainly work, will explode from maybe not this 2022, but let's say in 2023, because at the end it's a matter of statistics. If you put all the companies that have surpassed exits in the range of above 100, 200 million euros valuations, you can count them. You can count them, right? So at the end, all these investors that now are raising money and, let's say, allocating it, paying high prices in super early stage companies, in 5 years will not exist, as Adrián mentioned. And probably, at least what we observe in Spain, is that full of funds, less professionalized that we would expect. And this is not sustainable in the long run.
So Pascal, would you have an opinion on this?
Yes. One point is that interest rates are ultra low. So when you invest in bonds, basically you have a zero return or close to zero return. Not only that, but you are bound to bear your bond up to maturity, because there is the risk of an interest rate, long-term interest rates increase, which will trigger capital loss. So that will limit the new money which is going to go into bonds. People will keep their bond allocation to the minimum. And therefore, all the delta of liquidity which is being produced by people living longer and savings for a longer time will go either to equities or to alternative asset classes. So that in that sense, it's a good time to participate in these in the development of these asset classes, but I agree, subject to reasonable valuation. So I think in investment, one of the key mandate of a fund manager is to avoid bubbles. That's the mandate number one, I think. So we will have to deal with that influx of liquidity and that bubble risk, which has reached some companies or some asset classes already.
Yeah. Let's take a step back now to the more overriding total economy, because yes, the main question many will have now is that we are actually in a very uncertain period of time. We have this strange combination of lack of demand in certain sectors and inflation risk at the same time, and we have the uncertainty with the pandemic. How do you see the world economy for the next 2 years? Will there be a big discrepancy between the emerging markets and the industrial world? What do you expect? So
emerging markets, as soon as they are going to be freed from COVID issues, Asia is going to bounce very strongly. There is so you can split emerging markets in 3 categories: Asia, Africa, and Latin America, because Eastern Europe is no longer an emerging market to me. It's a developed market. I think some Eastern European countries have a GDP per person above Portugal, for example. So Asia is really going to be the key driver and in a strong bounce. Africa is going to continue to live its African life, which is a fine GDP growth rate of 4% a year. And the basket case is Latin America, which due to governance issues is gently sliding into either decline or chaos. So for emerging market, I have no fears about Asia. I would avoid Latin America, and I don't have much exposure to Africa.
Right. And you, how do you see the world economy? Is it a slow recovery, or will it be a kind of J-stick, fast rebound and happy go lucky for everyone after that?
Maybe I can give some opinion on that. You know, maybe because we work on the venture debt side and our mentality is more like risky ones and identify risk and being more pessimist. But I foresee for the upcoming years, and I'm not talking only in the following 2 years, but that the general panorama doesn't look really good. But because we will be paying the poor work that has been done from the last economical crisis, and now we have been hit by COVID, which was not expected in this path of recovery. And when we will be out of this, I think at least looking, for example, in Southern Europe, which is more, let's say, unbalanced, the richness of the population, I think what we, if the public administrations, and I'm not meaning by that only regional, but worldwide, don't do a big work here, the population will increasingly be more split, and there will be just few winners and many people having troubles with their daily lives.
Yes, to be completely honest, world economy is something that in our job, in our day-to-day job, doesn't, we don't spend many time on it, because many of the companies we invest in are disruptive companies that shouldn't be affected by world economy, or more local companies. But what we see, and I think it's something that can be applied also to the world economy, is that in many sectors, what we are living right now is kind of fictitious, because some companies what are having right now, it's some encapsulated demand from 2020. Right now, with the lack of, for example, semiconductors or other kind of raw materials, I think this is going to continue, but this is going to be fictitious. And when the supply comes back to what it was, I think we will see some downturns, both as in the economic world, in the real economy, and also in valuations and company performance.
Right. So your assessment is that supply bottlenecks are temporary, and when this is coming back to normal situation, you will have more competition, price declines, and more challenges to keep up margins.
Yeah, and our assessment is like this. Yes, and this demand right now is not real, and we are suffering the crisis of COVID and the crisis closely related to COVID, but the crisis of not having raw materials. No, so when this is done, I think the demand is going to go low.
Right. What I see as a challenge to understand, and it's a rather unique situation, and I would like to have your opinion on it, is on the one hand, we have a tightening on the monetary policy, increasing rates, the end of the extreme monetary stimulation with buying bonds and quantitative easing. and at the same time we have a huge public investments to be done in the United States and in Europe also. There's a big package to stimulate the economy. So we have kind of different forces acting together in different directions, and we are not seeing this before. So my theory, and challenging you, don't we underestimate the risk and the uncertainty about the possible outcome of all this, or are we too optimistic?
I don't think we are too optimistic. I think we are not enough optimistic. The US, I've worked with US companies for about 10 years, and the US has an enormous pool of talent and energy, and does not have the demographic problem that both Europe and Japan have. So the US is going to continue to be a very strong engine for world growth in terms of technology, innovation, capital markets, etc. And the US demand is bouncing, and the bottlenecks that we are experiencing at the moment are largely due to this US demand, as the Asian demand is only starting to recover. So if we add the US demand plus the Asian demand, it will take probably 2 to 3 years, if not 4 or 5, to debottleneck the world economy, which means that we have a 5-year period where demand is going to be much stronger than the offer, and that's very good for business, and that's very good for equities. So I think the risk is to underestimate the strength of the world economy at the moment.
Right, but don't you see rising interest rates as a risk for equities at the same time, or is it a golden situation actually where demand is so strong?
One, central banks have not started to increase rates, and central banks want to see whether the strong demand at the moment is temporary or not, and then they will act. So that means that central banks won't act until the end of 2022, if that. And during that time, that's adding fuel to the fire in terms of demand. And then, as we can see today, with raw material inflation, good companies have pricing power and are able to pass price increases. So that's not a big issue for equities, for good companies. That's a temporary issue. There is a lag between the effect of rising prices and inflation. There is a lag of 3 to 6 months, but after 6 months, all good companies have increased their prices. I was at the Swiss mid-cap seminar yesterday, and that's the speech that I got from all these high-cost Swiss producers, because they have innovative products, and because they are really they have difficulty to answer the client's demand. So the demand is so strong. So I don't see that as a risk. And the interest rate risk will happen from 2023 onwards. But you see, in Europe, we are following. I lived in Japan for 5 years, and in Europe, we are following Japan with a 10-year lag, basically. So Japan has had a high debt for 20 years. When I left Japan 17 years ago or 18 years ago, and already at that time we were afraid of the Japanese level of public sector debt, and that was 18 years ago, and they have lived with it for the last 20 years without interest rates moving upwards significantly, or without the trust in the Japanese credit rating being much altered. So it's not an issue for the next 10 years, I think.
Right.
I think
Yes.
I think the point you say, Jean-Pascal, is true. The other day I was talking to a guy that works at Fansmith, and as you know, they invest in high quality companies now, and what they say about this inflation is this kind of companies, good companies, are the ones that could resist better to inflation and crisis, because they are the ones setting the prices. But we can't forget, I think, and I don't really know I know more or less the Japanese case, but I don't know it in depth. But but the problem right now that many developed countries have is that we have our debt levels in terms of percentage of GDP are so high. So yes, and this is a risk itself. But if interest rates have to be touched due to this inflation, which I also expect to be temporary, but if this kind of if these interest rates have to be touched, this is going to be a huge problem for the countries, and this is going to lead to, I don't know, but maybe some bankruptcy in some countries. No, and also the other day, and related to the thing you mentioned, Erik, about the US and the kind of and the policy they are going to implement right now of spending a lot. No, I read an article in The Economist which mentions how is the problem with the US, that they have so much power that they are buying even more debt than what they can afford, because they are the main country in the world, no? So they have kind of a big negotiation power, and no one can stop them to continue issuing debt. So I think this at one point should stop. Again, I don't know in depth as Jean-Pascal too, but our opinion, and I think Jordi has some shared views with mine because we have discussed this topic sometimes, is this, that this kind of debt levels will have to lead to something not good. I don't know if in the next 2 years, but maybe in the next 4 or 5 years.
Right. Shall we discuss? Yeah. Sorry,
no, please,
Jordi.
please. No, carry on, Erik.
Yeah.
Was not that interesting what I was about to say.
No, I listen to what Jean-Pascal says about his priorities, and maybe you should dig into that if there's a kind of feeling that it's a positive environment for risky assets, in particular liquid equity, and we still believe money is coming into the more risky assets. What kind of sector, for example, Jordi, do you look for mostly? You said you were tech heavy. What kind of sectors are your preferences in this environment?
So, you know, if you asked me this question 2 years ago, would be different, because now we have like the 60% of the fund already committed. Venture debt works really well with SaaS companies, but obviously we wouldn't deploy all this money to SaaS, partially given to these high valuations that you carry straight from past investors. Actually, we are quite interested in investing among 2022 in food tech. We think now it's like it will change the mega trend regarding consumer habits in eating, and as well sustainable mobility, and as well and even reinforced by some outcomes from this Glasgow, let's say, worldwide meeting. Actually, the circular economy in, let's say, retail and some other sectors as well interested. So everything related to at the end becoming a more sustainable planet, and not because we are like yuppie and we just, it's not because of that, but because we will be forced, if otherwise our let's say our kids, well, it's not my case, but you know, will live in a planet that will not be nice at all. And for
the
us,
end-
it's yeah.
Yeah, no, in the end, what we've seen, we are of course focused on resilient sectors, but what we are seeing right now is this kind of resilient sectors, as a consequence of pandemic and many people not investing in other assets, like for example hotels. Let's imagine due to COVID, this kind of assets have valuations right now that
Super overpriced,
no
yeah.
matter the performance of the company, but it is going to be very hard to have a good return on them. So we are trying to move towards other sectors. I'm not meaning food tech doesn't have high valuations, no, but this is a sector that is burning right now. And yes, we try to look to new sectors closely related to sustainability, and also try to look to some opportunities in resilient sectors, which are not that high in valuation. And finally, because our fund is quite flexible, we have invested in some opportunistic opportunities or companies. For example, hotels and we are already observing that what happened in 2020, 2021, beginning of 2021, is not happening anymore. We expect this to continue due to the high levels of vaccination. And for example, in hotels, we are quite comfortable, and we think it's still a good moment because many hotels have gone bankrupt. So yeah, as Jordi mentioned, we are trying to go more sustainable. At the same time, we are trying to look to traditional deals in traditional sectors, but with in traditional deals in traditional and resilient sectors, but with not crazy valuations. And finally, we try to look to some opportunistic deals that can come, and we think for the moment we are related to COVID, they are not affected by COVID anymore, and the future is not going to be affected by COVID, but their valuation is affected.
Right. And Jean-Pascal, you mentioned companies and you approached the company focus and the sectors you didn't invest in. But what kind of, do you have a preference for sectors?
At the moment, my favorite sector is logistics. Because there are bottlenecks everywhere, and basically logistics structurally is a delta on growth. When there is GDP growth of 100, you have logistics growth of 150, 1.5. So that's a normal situation. And in a bottleneck situation, this 1.5 becomes 2 or 2.5. So one of my favorite companies at the moment is Deutsche Post. The name does not sound so exciting, but actually distributing letters in Germany is only 12% of sales. What Deutsche Post is before anything DHL. They own 100% of DHL, which is 40% of their profits. And they are growing into freight forwarding. They are the #2 freight forwarder for air transport, and the #1 or #2 equally with 𝗓𝘂𝘁𝗋𝗃, the Swiss company, for maritime freight forwarding. And they also are developing a classic logistic hub, a division. And also due to e-commerce, their boring Deutsche Post business is becoming exciting, because in DACH country, i.e. Germany, Austria, and Switzerland, we were a bit late in adopting e-commerce. Not so much in Switzerland, but in Germany or Austria. And that the COVID situation has boosted the e-commerce awareness and development in these countries. So altogether, Deutsche Post to me on 7 times EBITDA is a very good investment proposition. But there are other examples. And in general, we focus on the B2B businesses because of this bottleneck situation, and also because classic consumer companies such as luxury or cosmetics, etc., are already on very high valuations, whereas intermediate companies, when they supply chemicals, for example, or minerals to add to boost product efficiency, etc., they have very strong pricing power. So in that field, we have a position in 𝗓𝘂𝘁𝗹𝘀 in France, but also in 𝗓𝘂𝘁𝘃𝗀 in Switzerland, and of course 𝗓𝘂𝘁𝘃𝗲𝘀, which is a very resilient company. You need it's no longer a chemical company; it's a utility. The world needs oxygen, and I'm not so much excited, and they are not so excited by hydrogen products. In fact, they are almost soft on hydrogen, because there is a lot of excitement, but hydrogen is not so efficient in terms of total carbon footprint. So, but oxygen is growing at 1.5 times GDP.
Interesting. And do you see, do you invest already now for the post-COVID in your approach, or do you wait to see what the pandemic is coming out to? Because
I think you when you see how things are going, it's already too late, because everybody can see it. So it's in the market. So yes, we are heavily tilted towards post-COVID recovery, and also we are heavily invested in companies exposed to Asia through indirectly through Asia. So we have many companies which are exposed to Southeast Asia, to China, such as SEB, but the other SEB, which is a world leader in cooking instruments, and they are very strong in China and Southeast Asia. We are invested in Swatch. Swatch derives 40% of its profits from Asia, and in our Japanese portfolio, Japanese companies are doing pretty well in Southeast Asia, including in India, and our favorite stock in Japan is Suzuki, because of its strong position in India. Suzuki is allied to Maruti in India and has close to 50% of the Indian car market.
Interesting. And how do you see the COVID approach and risk into your portfolio for you?
So we are heavily we suffered from the COVID because we were not aware that we had such an exposure to government shutdown. So in fact, now that we are exiting the COVID situation, we have increased the position in the most affected of our companies, such as restaurant companies or food or beverages companies, and retirement home companies, etc. So if you take statistically how these diseases work, they last for 2 years, but after 2 years it just go away, and the population is naturally immune to them. So it started about 2 years ago, and it's dissipating. Of course, the media are making a big fuss about a resurgence of cases, but these cases are people who are not vaccinated, and 80% of the Western population is vaccinated, or 75% of the population is vaccinated. So,
but actually, yesterday was this news that says that in 4 months the vacuum efficiency drops till 56%. So I think this is the issue, that we will need constant vaccination.
Fine. I don't buy back. I'm not into pharma, but that's good for vaccine companies. But people will get vaccinated, so it's not going to be an issue.
You know, at the end, who pays for these vaccines?
Sorry.
Who pays for these vaccines? I don't know how to pronounce it properly.
In Switzerland, it's the government, and in most cases, it's the government. But it's not so expensive. It's not that is not a big cost. That's something like in the range of 5 billion for $5 billion euros for a company for a country like Spain or France and it's 1.5 billion for Switzerland. So it's no.
Okay.
Right. How much time do we have here? Are we, Hitel?
Erik, we are about to conclude the session.
Yeah, okay. I think we have had a lot of good investment advice, actually, both on the approach and the assessment of risks.
Yes.
And I'm happy that the first conclusion was that cash is coming and continuing to flow into risky assets, although Jean-Pascal has a very good approach without having the fully risky assets. So no, I think we can round up here. I think this has been a good discussion, and I learned a lot from it. So thanks for the panelists' participations.
Thank you.
Thank you.